Hello and welcome to this episode of FinTech Focus TV, brought to you by Harrington Starr, global leaders in financial technology recruitment. Head over to the Harrington Starr website today, where you'll be able to download our brand new documentary, The Era of Convergence, which charts the merger of traditional and decentralized finance. You'll also be able to see our new magazine, The Financial Technologist, with the top 1% Workplace Awards. Enjoy the show and we'll see you soon. Hello and welcome to another episode of FinTech Focus TV with me, Toby. Today I am very excited to introduce you all to Hristo Borisov from Payhawk. Hristo has been talking to me beforehand about what's been going on in the marketplace, in their business, their extraordinary business. It is a tale of incredible growth that we're going to be looking at today. We're also going to be talking about some incredible things that have been happening in the marketplace over the last couple of weeks, of which I'm sure you all can appreciate. And their view on this is extraordinary. So with no further ado, Hristo, lovely to have you on the show.
Thank you for the invitation. Happy to be here.
Absolute pleasure. I'm excited about this one. We've got lots to talk about. But before we get into some of the nitty gritty, can you tell us a little bit about who you are and what Payhawk does?
Yes, absolutely. So my name is Hristo Borisov. I'm CEO and co-founder of Payhawk. We're a company focused on spend management. We help companies issue company cards and manage spend across all of their businesses in 32 countries. We are a company founded in 2018. We have so far raised about $240 million. We are currently operating in 9 physical locations across Europe and in the US.
Fantastic. I mean, there's a lot to unpack just on that in terms of an extraordinary amount in a very short time to have been able to raise. We're also going to talk about some of the numbers of your growth a little bit later on. But I want to talk topically. It's been quite a couple of weeks, hasn't it, in the markets? We've seen the SVB collapse, I guess. We've seen Credit Suisse and everything that's been happening over there. Volatility, just when we thought we'd seen it all, we've seen a little bit more, haven't we? And there's a lot of commentary into that. And it affected you guys in particular. And I think the response to it, to me, it says everything about sort of entrepreneurialism, opportunism, and resilience in this industry. So I'm going to throw it over to you and talk a little bit about what's been happening over the last couple of weeks for you in the business.
Yeah, absolutely. So unfortunately, we were one of the companies caught up in the Silicon Valley Bank, drama that unfolded about 2 weeks ago. And I'm not sure when your audience is going to be listening to that, but today's 21st of March. So this was just literally last week, fresh. And so what happened to us was that obviously we're a company operating in, as I said, currently across 9 countries. And we're serving businesses to help them issue company cards, manage spend, and manage all the expense management for their employees in a very automated and efficient way, directly connected to different ERP systems. So we usually, obviously work with a lot of finance teams to help them really manage all of that in a single platform. And we got caught in that we had about 100 million, close to 100 million in Silicon Valley Bank, which was fortunately not an existential crisis for us because we had, enough money in different bank accounts, but still was a significant amount of money to, affect some of our long-term plans. And during the weekend, when everything was unfolding and when there was, rumors, it's important to point out that our money were in the Silicon Valley Bank in the UK. So that there was a lot of conversations happening. We're fortunate enough to be part of the FinTech founders community in the UK. So, we were monitoring very closely with the rest of the entrepreneurs how things are going to unfold. But one of the things that we started immediately being approached by other entrepreneurs is whether we are able to extend our credit cards that we issue both which are charge cards, both in the UK and in the US, companies that might be without any money on Monday. And even though we were kind of affected on Sunday, we had obviously a conversation with the investors, conversation with the board, and took the decision to actually launch an emergency credit card to companies both in the UK and in the US. That comes with zero interest rate because it's a charge card effectively, so that we can actually help those companies if they quickly need to have access to capital to be able to really cover expenses and payments. Our cards and our system is not used for payroll, but still you have a lot of commitments and payments that you need to make as a business. And we managed to really launch this in the afternoon on Sunday. And we saw a great response to the market because it was quite important for us to really understand how things are going to evolve. And unfortunately, we saw some companies, let's say, issuing credit cards or bank accounts in UK and the US. They were kind of started to pitch their solution even on Friday when everything was unfolding. And it was kind of a really, this struck us as a quite, I would say, immoral thing to do. A lot of those companies were, I would say, contributing to the bank run, because at the end of the day, all those companies are part of the FinTech community. And, this can happen to, let's say, not only to, let's say, their bank account as a corporate, but even to let's say, the banks in which they're safeguarding money and so on. So, being extremely responsible when it comes to how you handle this as a company in the financial services space is quite important. And I couldn't imagine what was happening in these, let's say, companies that were deciding, hey, let's go and use that opportunity and start advertising that we can open bank accounts to companies on Friday when people were still trying to get access to their money. And that's why we were strict of not doing anything. But on Sunday, when we saw that there is a very clear chance of people in the next, let's say, 24 hours to be without access to any kind of payments and any kind of funds, we decided to launch this emergency credit card. And luckily, things didn't have to go that bad, but still, we saw a lot of companies that, let's say, got scared in the process. They closed their bank accounts with certain banks. They started moving their funds, and we see a great, demand right now from companies that would need, credit cards and ability to actually use a little bit of a more modern solution where they can more efficiently use their funds.
I mean, that's just a crazy week, right? You're looking very good on it. It doesn't look like you were asleep for an entire week. So you've done very well with all of that, and fair play to you guys, because I think absolutely what you said there about that there will always be sharks circling to try and find an opportunity. And I think that the bit there was to have the human side and work out how you could actually add value to it. And if we go all the way back to to COVID times, I think the companies there that were looking to say, right, how can we help, are the ones that actually prospered long term over that sort of period as well. I want to come back to that scenario because, as you said, whilst it's not a terminal amount for you, it's a lot of money to basically have jeopardized over that sort of period. So for you as a co-founder in a business, and hearing that sort of news, and it sounded like there was a lot of poise and reflection from you as opposed to panic and hysteria. Tell me how you dealt with it as a team.
Well, I think the most important thing is not to panic. We quickly had to make an assessment of the situation. So the first thing you need to understand is, what does that mean? How much money we have in different bank accounts, how much money we have in transit, because that was the case for us. How does that affect our plans, immediate plans? So let's say, because I think the positive thing here was, hey, from what we are seeing, this is not a case of, let's say, fraud, where you can go and lose all of your money. So we knew that we're going to gain access to our money in one way or another way. And it wasn't certain where we're going to get 100%, but we were certain that at least 30, 40%, 50% will be highly likely to be retrieved. And that also played out a little bit more on how we would look at it. Because if that was, let's say, a situation where, if you look at what happened with, FTX or other cases, I'm sure people are going to also, in that case, get some money, but it is a lot more uncertain how much. In this situation, there was quick information on, how risky the position was. It was good that UK was ring-fenced from the US bank where kind of the trouble started. So I think we tried to assess all the information we had and just make a decision. What is the worst that can happen? Even, let's say, we don't have access to our money or even multiple, let's say, several months, and then we get access to our money and we just get, let's say, 20, 30% of that money. What does that mean for our business? And also quickly assess the situation, being a company into the space, working with customers to help them manage spend and expenses and, helping them get access to cards was quite important. And we had to quickly assess the situation. Should we be on the offensive and to be able to really help those customers in that position, or should we be defensive and just wait to see what's going to happen? We decided that the best way is to really go and offer this to companies, help them in that kind of underwriting, because again, we are calculating what is the percentage of money they're going to also try to get from this process. And we knew that this was going to be an immediate, let's say, cash crunch where you need to have access to funds immediately. But we were not that much concerned about your long-term outlook as a business. Fortunately, the bigger concern we had as a business was also about the domino effect this could have had on the industry, because let's say core part of our customers that we serve are fast-growing, scaling companies across Europe and the US that are, VC backed. So that could be, let's say, 25-30% maybe of our customer base. And we know that usually tech companies are using other tech companies, right? And if VCs along startups lost a lot of money, and then those companies went out of business or had to significantly decrease their operations, that would have had an impact even in a lot of businesses that were not holding money as SVB. So that was where we were a lot more uncertain on the long-term effect and impact that's going to have. And this was my, I would say, even bigger worry.
Yeah, I agree with that.
But at the end of the day, when things like that happen, you have to accept it and say, you shouldn't be saying, well, we should have done this or that, or we shouldn't have kept that much money. Lessons will be learned at some point, but not at that time. You need to say, okay, what are we dealing with? What is the situation? What information we have? Let's put together a plan that is practical and meaningful and not panic.
I think that sort of mindset of also of not panicking, but then also seeing the negative and how you can turn it into a positive is always going to be there as well. So I want to touch on that because, I think there's been some pretty strong government interventions, all over the world in the last couple of weeks that have created a little bit of a bounce in the markets, but also, created far less of a spread of panic than it possibly could have done. But I think there'll also be an element of fear. And so when you talk about that sort of ability to find investment for startups and for tech, and we've seen what's been happening to tech stocks for the last, 6 to 12 months or so, it seems to me a terrible shame to see the innovation that we've seen in technology jeopardized by fear in the marketplace. So when you talk there a little bit about the longer term effects, I'm really interested in this as a business owner myself and the marketplace that we serve. I'm sort of looking and speaking and scouring to people about what the overall appetite is and what the implications are longer term as opposed to shorter term. So you having looked at that and done your disaster recovery and triage, etc., tell me a little bit about where you see the market and what the impact of this you think will be.
Yeah, I think right now things that startup founders and business owners were taking for granted, the stability of the financial services system or the stability of every bank, is something that right now is a little bit challenged with what's happening with Silicon Valley Bank and also Credit Suisse in Switzerland. I think calculating the risk at any point in time is quite important, and building a very clear treasury policy is also important. So I think a lot of founders right now are doing, business owners are doing, is a little bit more of a clear treasury policy. So let's say never holding more than 40% of your money in let's say a single bank account, always making sure you have liquid cash for at least 12 months of runway. And then the rest of those money, let's say if you have extra cash for above 12 months, then you can put them on some instruments that have less risk and are kind of earning you some interest rate, especially in this environment where interest rates are so high. There is definitely a lot of opportunities that you can be looking at, whether it is T-bills or any other money market instruments that are available from different, banks and institutions. So I think just educating yourself a little bit more and making sure you have a little bit discipline on the treasury function is quite important right now. Also looking at, credit card providers or charge cards like what we do with Payhawk. We are not charging interest rates. These are charge cards. You spend them for 30 days and you pay them in full within 7 days. That just gives you some access to extra money and allows you to really decrease the risk. Also, a lot of, let's say, the FinTech companies that are operating across Europe and the UK and using the EMI licensing, they are safeguarding money with just normal banks. And usually, because of the construct of the FinTech companies, they usually deal with multiple currencies. Each of these currencies might be safeguarded in different bank providers, which is giving them, let's say, the best rate. So by definition, these companies are using the banking systems in a very distributed way, right? Using some FinTech companies and understanding how they're safeguarding money where and so on is also quite important. And that is, again, adding to the diversification of how you're dealing with your money. Because at the end of the day, money is your fuel, and if you don't have access to money, things can die quite quickly and quite scary, as a lot of people went through this movie last weekend.
Absolutely. And you're sat there and speaking to, you've talked about how you dealt with the thing, an incredibly, professional and mature sort of way of dealing with that. I imagine at the same time you're speaking to a whole load of people who are, not dealing with quite such poise during that sort of process. Tell me about some of the stories of people who you were talking to and how they dealt with that, the stress of the last fortnight.
Yeah, unfortunately, just because of the nature of our business and the scale of our operations, we didn't have all of our eggs in one basket. But if you think about companies operating mainly in the US or mainly in the UK and targeting the local market, many of them would have not had a reason to have multiple bank accounts. And we know from a couple of companies that had a lot of money, almost 95% of them are available in that, and then some of them might be available in, let's say, products like Payhawk and others. And I think for them, the outlook was pretty dark, right? You have to meet payroll in the US, twice a month. You have to deal with a lot of immediate expenses always, and not having access to funds have been quite damaging for them. So, a lot of people were trying to identify opportunities to really get access to either loans or quickly, get some backup from investors, or try to get, charge cards or get any kind of access to cash they can find. So definitely a lot of those companies went through a, very, very tough time. And I think that is going to be kind of a, earring for a lot of people to remember this kind of situation and to really prepare better for the future. And everybody should understand, when you go and put your money in a bank account, at the end of the day, you're underwriting the risk for that bank account, that this bank is going to be there and that bank is going to be operational, and which we are not used to. We used to trust the system, but when you go and look at a company or like a bank like Credit Suisse that has been on the market for, I think, maybe 140 years, being in a position where they have been, posting losses for multiple years and needed to be bailed out or needed to be acquired to ensure stability, that is a very alarming rate. We hopefully are not going to go through another financial crisis that happened in 2008, but, the outlook is not let's say, fully settled right now. And I think now is the time to really make sure you are prepared and you are not caught off guard.
Yeah, exactly. And I think if we've all managed to deal with the blows of the last couple of years, we're still for this anyway, aren't we? I think one of the interesting things you touched on is that you mentioned there about a sort of significant amount of money that you've been able to raise over the last few years since starting in 2018. And it's never been anything other than turbulent for you one way or another, has it? In terms of macroeconomics of starting a company in 2018 and seeing everything onwards. But we did see 2021 with the dry powder that was in the marketplace, probably the best time ever for a tech company to be looking to raise money. We saw 2022 that continued, particularly in the first half of it, and then tighten that up a little bit in the second half. And 2023, we're seeing another market again in terms of that cycle. I think there's an interesting piece now where it's a very, very good time for for VCs and private equity houses to be investing, because there's some good deals to be had. I'm not 100% sure as a founder it's a great time to be on the other side of that particular equation. But I think there's an interesting piece about attracting capital at the moment. I know you've got some thoughts on that as well. Tell me a little bit about where you stand on that.
Yeah, I think definitely 2021 was a year of, crazy valuations. And I can say it not just from what we have been experiencing as fundraising, but also as an angel investor investing in companies. Just expectations from founders were, skyrocketing crazy. People wanted their business to be on PowerPoint valued to 10 million because they were like X this, X that. And I think 2022 was kind of a hangover. We are still, a lot of people had to recover from that and just realize, hey, things have changed and there is a reason for that. And I think 2023 is getting back to more productive conversation, more conversation focused on fundamentals, unit economics, factors that are going to really decide the long-term success of a company or not, and less hype. Let's put it that way, right? And I definitely see activity starting to pick up with VCs. Definitely, there is I would say the best companies are built during the biggest crisis. Definitely, VCs have been, let's say, sitting around on a lot of capital in 2022. And now with obviously high inflation rates and interest rate environment and so on, they have to be in a position where they need to start making some bets. And a lot of them are investing and have been busy. I would say last year there was a lot of activity, but not much deals happening. So people are still talking, but just people didn't see the term sheets, right? And it was taking much longer for those that saw the term sheets to really arrive at to close the gap between the reality of what the VCs are valuing and what the founders are valuing their business. But I think I'm a lot more positive about 2023. I think this kind of activity and opportunities for founders are still there, and I do expect a lot more things to start picking up, especially in the second half of the year. I hope that the interest rate environment is going to start settling down. That's going to have, let's say, some positive effect on the public markets, especially important, let's say, for all, let's say, crossover investors that are investing both in the private and in the public market. They're quickly affected by these big changes, and a lot of, value has been wiped out from the public markets in the tech sector in the last year. So hopefully we're going to start see a recovery for that. And I think right now there are some really, really good opportunities. Even if you look at the multiples on the market and on the public market, things are becoming a lot more real, right? And businesses, I think, are becoming a lot more real. And the other opportunity is that 2022 might have been a year where, still entrepreneurs were expecting a lot. And then they realized that, unless you focus on fundamentals, gross profit, long-term health, long-term strategy, and sustainable growth, it's going to be really hard for you to fundraise money. And I think a lot of those companies did a lot of course corrections last year on how they're thinking about their outlook in the next 2 to 3 years. And I think that is a healthy thing that needs to happen from time to time. And definitely, I'm a big believer that, right now, what we're going to see in the next 2, 3, 4, 5 years is not going to be anything near what we saw in 2021, which was kind of, I would say, very, very extraordinary.
Yeah, I agree with that. And I think this makes it a much more real market, doesn't it? And what I mean by real is I think there was some, fantasy world things that were happening in the space at that sort of stage. But I still think now that this is where it should be as a marketplace in terms of investment. I think, investment should be about good ideas and good businesses attracting good money behind it, as opposed to speculation and wild bets and wild valuations that tend to be only sustainable for a certain amount of period. So, whilst it might not necessarily be absolutely ideal from a founder perspective, I think what you will see is the good companies, the best companies, continue to attract investment with strong business plans, and, as you say, a focus on the right things, as opposed to years and years of loss-making activity, which never really computed in my head at the same sort of time as well. And speaking of sustainable growth and profitable growth all the way through, it's quite a year that you've had over the last couple of years in terms of growth. So the company, I think we were talking about beforehand, 62 people. About 12 months later, you're 262 people. So we're seeing some fairly aggressive growth on all of that. Tell me a little bit about the expansion. What's prompted it? How have you managed it? That is an extraordinary scale of growth to manage as an infrastructure as a business. And there's a lot of companies that can get that right and really, really thrive. And there's a lot of companies that get that wrong and sort of fail to maintain their culture, their DNA, their vision, through the business. There's now far more people who weren't here a year ago in the business than were here. I imagine there's far more people than were part of that original founding crew at the same sort of stage. So tell me about some of the sort of teething pains of that. And by the sounds of it, you've got it absolutely on point. So I want people who are ambitious and enthusiastic and looking for positivity and growth to listen to what you're going to say now and say, this is how you can follow that pathway. Tell us what the secret potion is.
Yeah, I mean, first of all, to answer the first part of the question, what prompted that growth was, market demand and market opportunity. So we're coming on the market with extremely competitive SaaS product. We have been extremely highly rated from existing customers, and we have been seeing a great potential to really not only serve customers in Europe, in the UK, but also in the US. We were the first company that came from, let's say, headquartered in Europe and going into the US with fully credit product. And that became a quite big part of our strategy, because we started seeing a lot of companies coming to us for having a single solution to manage their spend and to really be able to enforce the same policies and the same strategy when it comes to, how you spend company funds. And a lot of European companies do have business in the US, and they were always forced to use something else in the US. And with Payhawk, we were able to really close that gap and provide them with a single product. So that on its own really sparked a lot of our growth. And the second thing is, in general, Europe is a very fragmented market, and being able to really sell across Europe is not an easy thing, especially in payments, because you need to really cater to the local specifics. And that's why we have teams based in Spain, France, in Germany, in Netherlands, in the UK, in Bulgaria, now in New York as well. So being able to really sell to those local businesses, we had to have a local team, local account executives, local BDRs, local customer success and support that was necessary for that growth. And we were really driven by the demand on the market. Of course, you need to take a leap of faith and try to be ahead of the market in certain segments. So I think the biggest challenge for us has been really to ensure that we are being able to quickly adjust our business month by month. So we're doing obviously forecasting, and as soon as we see how things are, we are adjusting our headcount and our plans as the market is, because definitely you don't want to put a plan for 1 year, then to hit all the expenses and not to hit the revenue by 50%. So you want to be in a position where you are controlling both. Just as an example, during 2022, at some point, we had a plan to grow from up to 410 employees. Then we contracted this to 350, then to 310. Then we ended up at finishing the year at 260 employees. And that was kind of a reflection of how the demand is on the market, how we're growing, and how we're expanding, how we are able to prove different channels, how we are able to spark different markets. So those were quite important for us in that journey. In terms of maintaining the culture and the team together, what we do as a team is we gather everybody twice a year, a few days, a company event on a team building. So we go once a year to a winter resort, once a year to the seaside, and we try to spend as much as possible as a team. And the other thing that we had to do is we are a very heavy in-office culture. And we have been this way always. Which was obviously a little bit hard last year when people were coming out of the COVID world. They were like, "Oh, I want to be remote for the rest of my life." Well, it's great, but it's not in Payhawk. I mean, and the reason for that was not because there is this notion that we attract and we say, "Hey, we are mostly live for office culture." They think, "Well, if I'm remote, maybe you're not trusting me." No, actually, we trust you. And we believe that sometimes people might be even more effective if they're working from home into an environment, to spend time in commute. But what you're missing is the opportunity to really help others and to work and interact with others. And this is the place where 1 + 1 = 3. And that can only happen if you're in the same office with the rest of the team. And what we were seeing is that onboarding was the hardest thing. And getting that many people into the company, not being among other experienced people, was really hard for them. Because at the end of the day, this is where you're forming the culture. And obviously, I would say we have maybe lost amazing talent that didn't want to come to work for Payhawk, and that's fine with us. Because at the end of the day, we're looking for the people that have the right motivation and are looking for the right dynamics. And it's not for everybody. The same thing is like remote is not for everybody, right? There are people that prefer to be in the office, and we have never had this kind of a really big problem of employees being, all of the employees want to be working from home. We are extremely flexible. We are providing employees once a week to be working from home if they need to take care of something and so on. We have a very flexible travel policy so that they can actually work from any of our offices, fully covered by Payhawk for 5 days in a year. We are also allowing them to work from anywhere. So if they want to go and work from Bali, we're providing that for 2 weeks. So we do have these perks, but then within a certain limit. We are currently providing all of our employees with allowance for travel to the office. So we're paying €150 or £150 to our employees to commute to the office. as an additional, incentive. Obviously, they're paying it on their Payhawk cards, so they're also a user of the product, which is great.
There you go.
But at the end of the day, it's really keeping things together has required a lot of thought on how we are going to, what kind of talent we need and what kind of people we need and what kind of culture we want to build. And I would say that we have been seeing extremely high quality talent coming to Payhawk, and we are absolutely satisfied with the quality of the team we have built. And we're obviously also keeping the bar very high. We are very performance-driven culture, and that helps because at the end of the day, when you're data-driven and everything is about performance, it is much easier to have these conversations with people when things are not going well. So you have to manage multiple things at the same time, but luckily we feel in a good spot.
I think that's really interesting you say that, because I think when you're doing that level of hiring over a period, as a effectively small business growing into a medium-sized business, and you're talking particularly over the last couple of years or the last 24 months about the access to talent that's in the marketplace, and particularly with tech talent and their demonstrable lack of desire to be in offices at various different stages. I find it fascinating that you can keep that talent density. And I think if we look at some of the big tech companies and their growth over the last couple of years, it seems to have been a little bit bum on seat mentality, as opposed to keeping talent density and being able to really go through that. So I'm really interested as to why so many people have been able to sign up to Payhawk to say, yes, I want to join that business, when there is such a considerable pressure on finding good talent. It's not been an easy time, as my day job tells you. It's not been an easy time to attract and engage and retain the best people in the marketplace. And there's been some crazy numbers that have been necessary for a number of companies to be able to do that. What's been the secret behind your ability to attract and engage the very best talent in the marketplace, and at that sort of scale, at that that sort of speed as well?
Yeah, I would say that talent is usually attracted by the opportunity, by the size of the opportunity, and that one is extremely clear for Payhawk because we're operating in a market that is now emerging, really bridging the gap between software and payments is going to become even a bigger thing. We believe that in the next 10 years, almost every company that's going to be dealing with software selling to businesses would have some kind of form of payments integrated in it, because at the end of the day, payments are the way you do business, right? And the opportunity and the simplicity of what Payhawk does has been very big factor, because sometimes you can join companies and it takes you time to understand what exactly is the company, right? And having a card in your pocket, showing to somebody immediately tells you what this is. And a lot of us have been on a business trip. We know the nightmare of spending our own money and then building expense reports and then reimbursing these expense reports or waiting to be reimbursed for months is a nightmare. And not having to do expense reports, being able to use a company card, being able to really have access to these company funds has been an amazing experience and engagement for employees as well. So they fully understand this vision of you having a better trust with your finance team, so that they can trust you for you to use company funds. But on the other side, within let's say, it's kind of freedom within a framework. So that's been one part. The second part has been that within a very high growth environment, I think that adds a lot of premium talent. People that are currently on the market that went through this kind of extreme growth, I would say have a big premium, because they have seen the very different stages of the company, very different problems. Things are very dynamic, and we joke internally that 1 year at Payhawk is like dog years, 7. They feel like that. But I think that is exactly where people want to get out of the comfort zone, focus on learning, and do their best for this to be kind of a career defining moment, right? And those people that we are currently attracting, I just spoke before the interview with the person that's coming from, I would say, one of the most high quality VC funds in the UK, and that person has been for 3.5 years there, and he's looking at Payhawk as the opportunity to get into this high growth learning environment. Where he can really just define his career in his 20s, and he can really discover what he wants to do after that, and whether he's going to start a business or whether he's going to join another business at a later stage. That is a great opportunity to really see scale at its best.
And I think it's great that you see it like that as well. I think sometimes people are looking at it and saying, right, how can we get those people who are going to be there for forever? But I think to recognize that and say, how can we move people through there is probably part of the attraction for you guys to say, look, let's give you an experience of growth that's going to really benefit you in your CV and your career, which is a really exciting way of looking at it.
I think that is very fair, because at the end of the day, we realize that, the company every, let's say, 18 months to 24 months goes through a very different challenges and different scale. And people that were an amazing fit at some point might have struggled with the business and the size. And at the end of the day, I would say that one of the things we are going to be most proud of, if there are many other companies started of employees after Payhawk, right? That they have used these, learnings, and they can go and apply them. And, that's going to be great for us, because it means that these people really manage to, build the confidence and to get to, understand what they want to do and go and do it. And I'm sure we're going to be at that point at the stage where maybe other type of talent would be needed, where it's not going to be that much, let's say, builders, but rather more of an operators, or we might have different product lines where you can have, more of an entrepreneurship mindset, where you need to be, bringing new products to market. And there needs to be, let's say, more of a operator setup for core of the business that is really, let's say, down the road, the cash cow. I think that you need different people for different purposes. And I think if you lay it out as an opportunity for both parties, I think that's the most fair approach, rather than to believe that these people are going to stick around just because you want them to.
Yeah, I absolutely agree with that. I've just caught the time here, and as I thought might happen with this, we've gone way over time schedule, but I'm really pleased with that. It's been a conversation that's been in dog years, to coin your term. I feel like we've been talking for 5 minutes already. I'd love to go into this in a lot more detail, and there's other things that I'd love to talk to you about on a follow-up to this episode. I'd love to have you back on the show to talk a little bit more about the Payhawk story. I find speaking to people like you really inspiring, really exciting, and it's been one of the great pleasures of the last couple of years to speak to as many founders as I have. And to go through this story and how you've dealt with such grace and decorum, what's happened over the last couple of weeks, and to be coming out of it almost in a stronger position, I think is absolutely remarkable. So you have nothing but my utmost respect for what you've done and what you've been achieving, where you've taken the extraordinary company that you're building at the moment. And I've got no doubt about where it goes over the course of the next few years as well. Let's finish off, Hristo, just by talking a little bit about what we can expect to see in 2023, the rest of 2023 for the business. And who should be getting in touch with you, and what's the best way of them to be able to do that?
Yeah, absolutely. So best way is to visit our website at payhawk.com. You can also reach out to me at on LinkedIn with Hristo Borisov. We have presence in pretty much almost all social media channels. What we can expect from the business, who are the people that are usually getting in touch with us, are companies that are fast growing, that are scaling, that are, expanding in multiple geographies, that are really want to be in position to really have a good grasp of their spend and manage all their expenses in a lot more efficient way as a business, have real-time visibility of what's going on into the business, provide their employees with access to company cards so that they can, be a lot more integrated into how, the business is happening. And usually those are most of the time the finance team. We 95% of the time sell directly to the office of the CFO, where it's a VP finance or finance managers. What we can expect from us this year is that we're working on a lot of exciting new products that we're going to be adding, including cross-border payments, more premium Visa cards that are coming with insurance. We are going to be looking at diversifying, and adding more countries and adding more capabilities to our product. We're working on a lot of the software part, so we are going to be able to really do a lot more things that are necessary by a larger enterprise, like purchase ordering, budget management, supplier management, and how all of those things fit together so that you can actually manage your business in a very efficient way. So a lot of exciting things are coming. Visit payhawk.com to learn more and hear about us.
I definitely will be doing that. And there's so much more I want to dig into about this sort of business. Hristo, that has been one of my favorite episodes so far. Mm-hmm. Absolutely love what you're doing, and congratulations on everything that you're achieving and where it can go. I'm certainly going to be a keen fan, a supporter, looking forward to seeing where you can take the business. Thanks so much for joining us on the show today.
Thank you for the invitation.
Absolute pleasure. And thank you all for watching. We will see you soon on another episode of FinTech Focus TV. Thanks a lot.